today I'd like to look at factors that affect investment. Investment is expenditure on capital goods, something that's used in a productive process, for example buying new machines, building a new factory. And there are many factors that affect investment, including interest rates, economic growth, confidence of firms, technological development, the availability of finance, inflation, wage costs, and government policy. So let's look at these in more detail. So if we take interest rates, this is very important because interest rates determine the cost of borrowing. When interest rates are low, it's cheap to borrow, and therefore firms are more likely to invest. Because if you can borrow at, say, 1%, but your investment gives a rate of return of 5%, then that's a project that is worth doing because the rate of return is higher than the cost of borrowing money in the first place. But as interest rates increase, then it's more expensive to borrow, more returns from saving, and so therefore this will tend to decrease investment. Now, interest rates aren't the only factor, because in the past 10 years, interest rates have been very low. Base rates set by central banks have been close to zero ever since the financial crisis, and yet investment levels have been quite sluggish. So even though it's cheap to borrow, that may not be sufficient. Another very important factor is economic growth and perceived consumer demand in the future. So firms will invest when they think there's going to be more demand for buying their goods in the coming years. So for example, there's been a lot of investment in electric cars because car firms feel that this is going to be a growth area. But in many other sectors of the economy, because the economic growth has been quite weak, firms are not convinced that demand is going to be rising strongly. So they've tended to hold back from investment projects. One theory of investment states that it's the rate of change of economic growth that is important. This is known as the Accelerator theory, and this suggests that investment can be quite volatile. If there's a rise in the rate of economic growth, then firms become quite confident that demand will be rising, so they increase investment quite significantly. But if there's a slowdown in the rate of growth, if firms feel the economic cycle is kind of on a turn, then they'll cut back on investment, because you don't want to invest a lot of money if you feel the economy might be heading towards slower growth and recession in the future. One very important factor for determining investment is confidence. John Maynard Keynes referred to animal spirits of investors. And this is just simply, do you feel optimistic about the future? Because a lot of investment decisions do come down to the confidence and expectations of those in charge. So in a period of deflation and low growth, confidence tends to be quite low, which is why investment has been quite disappointing in the past couple of decades. But when confidence is high, like in the roaring 20s or 1950s and 60s in the post-war economic boom, then the confidence of firms is quite high and they're willing to take risks. They're willing to borrow and build new factories and machines because they're hopeful demand will continue to rise. And it's worth saying that confidence can change very quickly. So for example, up until the financial crisis, confidence was relatively high, but a few high-profile news events about Lehman Brothers going bankrupt and runs on banks, and confidence changed very quickly for both consumers and firms. So investment is quite a volatile part of the economy, and we can see quite rapid swings in the investment cycle. Another factor that affects investment is more on the supply side, and this is related to things like technological developments. So for example, if you bring in a new technology that is really quite effective in increasing productivity, then there's a bigger incentive for firms to invest. So for example, when the assembly line became popularized after Henry Ford introduced it for Ford cars, then other firms looked around and said, well, this is really worth doing because it can increase productivity quite a lot. So there's a real need to invest in that kind of new technology. Some economists say that slower rates of growth and slower investment levels are due to the fact that the technological innovations aren't quite as dramatic as they used to be. Now, it's true we have things like artificial intelligence and robots new, more powerful computers. But it was a slowdown in the rate of technological progress, then we may well get a slowdown in investment because the rate of return is less than it used to be. Another very important factor that affects investment is the availability of finance, because it may well be that a firm wants to invest. Interest rates are low, it thinks it's got a good product, it thinks it can get a good rate of return, but when it goes to the bank says, sorry, we're not lending to small, medium-sized businesses. And this happened after the credit crunch of 2008, because banks themselves were short of money because of the global credit crunch, and so interest rates are low, but they didn't want to lend because they didn't really have the same cash reserves they used to, or at least they didn't have a willingness to lend, and so that held back investment. So sometimes investment can depend upon government policy, because in theory the private sector don't want to invest, the government could step up, lend to business, like they did in the lockdown situation, lending to business to help them get through the downturn. And also, of course, governments can invest directly in public sector work, so building new roads, building new schools and hospitals, and this is counted as public sector investment. And this is less influenced by the economic cycle because it depends more on government policy. A few other factors that may affect investment: inflation. When inflation is high, the kind of uncertainty and when inflation is high, the uncertainty may discourage firms from investing because they're not sure on future costs and future prices. So it's tend to be said that low inflation does tend to encourage investment in the long term because there's greater certainty, greater confidence, and firms can plan ahead. But if inflation goes up, firms may kind of cut back on investment, wait to see what happens to inflation. Another factor that might affect investment is wages. Supposing we get a period of rapidly rising wages, this means that labour will become more expensive. So in this situation, a firm may respond by saying, well, if labour is expensive, we need to invest in more capital-intensive methods of production. You know, if the supermarket has to pay higher wages to check out operators, then it might think, well, let's invest in new automated tills, automated apps that enable us to have lower labour costs, employ fewer workers. So high wage growth may encourage investment. And equally, if labour costs are very low and stagnant, not growing, then firms may think we don't need to invest so much in capital because we can get away with just employing cheap labour. So those are some of the factors affecting investment, both from the demand side and also the supply side of the economy. If you like this video, feel free to subscribe. Lots more great economic videos coming soon.